Hey guys, Dave with Moniology here. Hope everyone is having a great weekend. Today's August 4th, 2019, and this is the weekend market review where we take a look at some of the most important market indices and try to get a better sense of what's taking place in the market and where we might head going forward. And this particular video series is from a daily perspective. So we'll start with the 10-year US Treasury as indicated by the TNX, and as you see here, these numbers indicate the yield right now. So we closed the week at 1.855 in the yield, and we broke below this particular quote unquote uptrend in yield. So, and we closed the week below the 31 level of RSI, which is a very bearish indicator for yields. And it's my perspective is that this is an indication that the economy is significantly weakening here and that the markets are pointing toward continued weakness. So we'll go through some of the names, reasons why I see that in addition to this chart. But again, the 10-year yield closed at multi-year lows at 1.855. And by all signs and measures, we're going to see another rate cut, 25 basis points in September. So we'll see what happens. I know that the European Central Bank is looking to cut as well. So we might see continued lower yields, and that would bode very well for fixed income and not so well potentially for higher yielding equities. So here's the 10-year U.S. Treasury yield over the 2-year U.S. Treasury yield. And this one had been building some strength, perhaps in a rounded bottom here. And we broke out of this rounded bottom and back in June, and the market coincided with a very nice move to the upside. And here we created a head and shoulders formation, and we broke lower. And so this potentially further puts into to play the inverse, or rather the negative yield curve and the inverted yield curve. And you see that this downtrend, every time we've hit this particular line in momentum, we've moved lower. So, and we couldn't even hit it this time around. So likelihood is that the 10-year yields continue to move lower, and the likelihood of further rate cuts going forward is increasing by the day. Dow Jones 2500 index. These are the 2500 largest companies in the world. And I've been pointing this out. We broke to new highs here and here, but momentum did not break to new highs, and that was a negative divergent sign. Also, every time we tried to hit this 69 level of RSI, we could not do so, and we pulled lower. Last time around, we weren't even close, and here we go. We broke lower, and likelihood that we make a move towards that 200 daily moving average is increasing, and in my opinion, we'll probably break below it, possibly to test that 6900 level, shake out some of these longs that perhaps have stop losses below the 200-day moving average, consolidate here for a while, and then either move back higher or resume the downtrend. We'll see. Here's gold. Gold's breaking out to new highs. We closed the week at highs of the week at 1457, slightly above the 69 RSI level here, and it looks like gold wants to make a run towards that 1500 level, possibly around 1520, before any signs of a pullback do occur. But gold is acting perfectly right now for the bullish for the bulls. High yield bond index, the junk bonds. This is an indicator that, from my perspective, tracks the credit conditions in the overall market. And whereas they've been very good for the last even the last couple of months, we could not break higher here, and momentum was considerably weakening in each consecutive attempt towards a breakout. And now we broke lower. Now we're retesting this downtrend here, so there might be some support coinciding again with the 50 weekly daily moving average of 107.50. But I think if that breaks, then we're likely going to retest this breakout point and possibly lower towards that 200-day moving average around 105. Here's a high yield ETF relative to the 7 to 10 year Treasury ETF, and this also tracks the risk on trade, if you will, in fixed income. And when this ratio breaks down, which it has done here, and it's broken down pretty substantially, says that credit conditions are weakening and the probability of a recession is increasing pretty dramatically. So here we go. If this particular trend line breaks to the downside, I think you're going to see some pretty substantial volatility coming into the markets. Here's the housing index, and that too has been weakening. You see just a negative trend in momentum, and we're hovering just above the 50 moving average, 50-day moving average, but we're likely headed lower unless we can resume to the upside and break above this downtrend. Here's the 20-year Treasury bond versus the inflation tips bond, and this is a indicator of how well the safety trade is doing. And if this particular indicator is breaking out to the upside, this suggests the safety names on the fixed income side, recessionary names versus inflationary names, deflationary names versus inflationary names, are breaking to the upside. And here, unequivocally, uh, recession slash deflationary names are breaking out, and that's not a good sign for the bullish case. But for fixed income investors, especially those in the more conservative, higher quality names, that's a very positive indicator. And it looks like we're moving to not only new highs, but just a renewed outperformance of fixed income versus equities. Here's crude oil. Crude oil is in this pennant pattern right now, in the symmetrical triangle, and we'll see which way it breaks. It broke down on momentum, so is this a back test and then break lower, or is this a fake out and then we move higher? So time will tell. If the view on equities that we're starting a corrective period in the markets, then likely crude oil does follow lower. Nasdaq Composite. Nasdaq is we had a bearish wedge here with negative divergence. We broke lower, couldn't make new highs on the breakout in price, and now we broke the week below the 50-day moving average, and likely we're going to in a stair-step pattern probably head lower towards a break below the 200-day moving average, at least for a while. Here's the Nasdaq equal weighted, and this gives us a better sense of what's taking place underneath the surface of the Nasdaq without the momentum names that are at the top of the Nasdaq. And as you see here, it's breaking lower, and we might find support around that 38 RSI level. But if that breaks, then again we're going to test that 200 day moving average. The Russell 2000, those have been the weakest. It's been the weakest sector amongst the major sectors in the market. And whereas Dow Jones, the S&P, and the Nasdaq had been breaking to new highs, that wasn't the case with the Russell. Now it is consolidating here, which is positive. But if we continue breaking below this particular downtrend, then we're going to retest the lows here at 1460. If we break below that, and then we're going to make a run towards the late 2018 lows. Unlikely going to happen, but definitely something to keep an eye on. S&P equal weight, that one's breaking lower, again finding support potentially here at the 38 level, so something to keep an eye on. If we get some bounce, this would be a good area to do so right now. The S&P SPYs, SPX, that one also around the 38 level. So I'm watching this. If this bounces here, this will be a reason why, because 38 level of RSI is a great retracement level for Fibonacci sequences. But if it doesn't hold 38, then likely we head lower. Semiconductors, a good barometer on the economy. We broke out above this bearish wedge, which is a very bullish development, but then we broke lower, and here we are right now testing the 50-day moving average. We'll see what happens. There's still some downside before even the 38 level of support is hit, so I can see this move lower in the coming week. Here's the total stock market ETF, includes emerging and developed European and emerging markets. And you see here where we've had quite a down move so far. So we're at that support level. We might see a bounce this week. If it doesn't, just like with the other markets, likely headed lower again. Transports could not even break the momentum downtrend that's been established into 2019, and we broke below here this uptrend, and now it looks like we're headed lower, below the 50-day and below the 200-day moving averages right now. It looks like we're heading lower towards that 9,800 level. So the transports are a barometer on the economy, and they're not showing strength right now. U.S. dollar, we had a pretty strong shooting star pattern here, and attempted to break new highs, and it didn't work. We met resistance where at the 69 level of RSI. That's happened before here and here, and so if we cannot hold that 97.60 level, first of all, that will be incredibly bullish for precious metals, but that also will be very bearish for the US dollar. Don't know what's going to happen, but I'm watching that 97.60 level very closely. Volatility index. So the volatility index broke above this bullish wedge here, and now we're above the 50-day, above the 200-day moving average. The 50-day has not yet crossed the 200, but something to keep an eye on. We did close the week above the 61 level, and so it looks like volatility is going to continue to spike over the coming weeks ahead. And finally, a couple more. Wilshire 5,000, the 5,000 largest names. This one broke below the 50 RSI level. Now we're on that 38 level of support. Let's see what happens here, just like with the other particular indices that we've covered. And then finally, the world ex USA. So that's the weakest of all. And in a strong global economy, you want to see the world indices outperforming the US, since there's a lot more risk there, and therefore you expect them to do best in a booming economy. It's not the case here. We're below the 50, below the 200 day moving averages already, and we closed the week right below the 31 RSI level, which is very, very negative. We're likely going to make a retest of those lows that we saw in early June. And if those do break, we're going to watch those very closely. If those do break, then I believe they will, because right now we're showing negative divergence on momentum. We're nowhere near the June lows yet momentum is effectively at those levels. So if those continue to weaken, I expect to see a very strong move to the downside below these lows here, and possibly a retest of the December lows before this correction is over. So overall, guys, not too many positive signs on the general equity markets. Fixed income looks good in the higher quality names, and volatility looks good. Precious metals looks good. Oil, not so much right now. It's kind of in a consolidation pattern, trying to figure out direction. And that's it for me, guys. So thank you. Let me know what you think. Shoot us a note on YouTube, Twitter, or StockTwits. Any feedback is very much appreciated. And please check out Moniology.com in the coming days and weeks. It's going to be awesome. We're working very hard on a launch of our new website, and we're doing it for you. So we appreciate all the support that you can give. And thank you, and best of luck trading and investing. Have a great week.